Hi, this is Carl. I'm continuing on with my fundamental analysis. This is part two. So let me review what we discussed in part one. So in part one, we discussed cyclical versus secular. Cyclical are businesses and stocks that require the business cycle to grow. So you do hear about how in the business cycle unemployment's going down and jobs are basically being filled and people are being hired. Those are essentially companies that require the business cycle to grow for their revenue and earnings to grow. Uh, Things that are usually associated with that are the industrial stocks. You can consider stocks such as Caterpillar or Deere. Basically, farmers are planting because demands are higher, so they require more equipment. So they need to buy more equipment from Caterpillar. And others along the same line is railroads. Railroads basically transport more things as well as delivery trucks. So delivery companies such as UPS and FedEx, etc., require that also. Airlines also, you have basically more travel due to business, and the more travel you have, you basically require more planes, and more planes require more parts for the planes. So planes are basically Boeing mainly being the main one, but you also have suppliers to them such as GE providing engines and many other companies providing electronics to them. Same thing with automobile. Automobile essentially would be in higher demand because consumers have more money, so they tend to buy more. That gets into your consumer discretionary stocks. Consumer discretionary stocks are luxury items or extra items that uh, the consumer, when they have money, can use to buy. So things as watches, um, cameras, TV, etc. So stocks along those lines will grow much more significantly in a growth business cycle. Stocks that are not dependent on the business cycle are basically called secular. So the secular stocks are things such as the consumer staple stocks, things that they require, such as food. So you can think of General Mills, etc. Also, basic needs such as toothpaste and soaps. So Colgate Palmolive, things like that, Procter and Gamble, and healthcare industry also. So you still need to go to the doctors, things like that. Along with that, also utilities. Utilities are basically only dependent on the growth of the population and the growth of the population requiring essentially a larger supply of electricity. You can also have a cyclical piece of that also because business will require essentially more power, city will require more power, industry will require more power also. But they tend to be not as great as the general population. So things such as PG&E is pretty well consistent. They do have some variation due to cyclical piece of the business, but they tend to be small transitory excursion, not a major long-term requirement. Other terms that was used is the price to earning multiple. So usually referred to as the PE ratio. That is probably one of the more fundamental valuation of a stock, mainly because if you think of P as being the price you pay for the stock, E as the earnings per share, that if you own a share of the stock, you would like to get a payback on that. And in a sense, it is a payback period. So if you have a price that you pay that is, say, $20 and the earnings is $2, your PE would be essentially 10. And if you think about that 10, it would take you essentially 10 years of this constant earnings to recover your price of the stock. So think of you buying something for a certain price and how quickly you get paid back for it. So the lower the price to earning, the quicker you purchase it back. So if you pay a PE of 5, it takes you roughly 5 years of the same earnings to essentially recover what you paid for. So that would be a good deal if you can get something like that. But what usually happens is you'll also have growth stocks. Growth stocks basically has earnings that are growing significantly, and because of that growth, you would recover the earnings, your you would recover what you pay for it in price sooner. So the first year the earning may be $1, the next year it could be 1.4, the next year it could be 1.88 or 84, and the next year after that it could be 2 point something. So in a matter of 4 or 5 years, you could significantly improve over that initial price to earnings. So therefore, the multiple could be higher for growth. Other terms that was referred to is essentially in the income statement. During the income statement, you essentially have statements such as the revenue, and the revenue is also known as the top line because that's usually the beginning or at the very top of the income statement. From there, you look at breakdown of costs and other things, and at the very bottom, after subtracting everything off, you essentially get what is the earnings, or in some case, earnings per share. And again, we prefer the earnings per share because the PE ratio, the main financial metric that people use, based on the earnings per share. Another term is the gross margin, and this is useful because this tells you what percentage of the next dollar of income would be profit. So that is usually calculated, the gross margin, by revenue minus the cost of the revenue or cost of goods divided by the revenue to give you it in percentage form. So an example here is if you have $10 million of revenue, cost of goods is $8 million, your delta or profit is 10 minus 8 is $2 million. So as a percentage of your revenue, that's 2 million over 10 million. So that is 20%. So for the next dollar of earning or dollar of revenue, you would earn 20 cents. And that could give you an idea of how the earnings would grow with the projection of revenue increase. Okay? So that's most of it. The next I'm going to review essentially is the risk reward, and we'll go jump to Jim Cramer presentation for that.
Consider this show your Wall Street to English dictionary, a televised glossary that will help you navigate your way through tough markets, and more important, the tough-sounding terminology that keeps so many people out of stocks or makes them scared and buffaloes them. The fact is, all this investing terminology sounds difficult because the pros who speak Wall Street gibberish fluently, they want it to sound difficult. They want you terrified and feeling totally ignorant, at a complete loss when it comes to managing your own money. And judging by what I often read on Twitter, at Jim Cramer, and you know I go there all the time, at Jim Cramer, the arrogant, self-centered managers, let's just say, they are winning. My mission is just the opposite of theirs. I'm here to enlighten you, to teach, because I know that you can do better for yourself than the professionals, who mostly just want your fees and commissions, and I know you can top them. I don't want those fees or their commissions, by the way. I don't want that at all. I'm not managing anyone else's money, and I don't own stocks, except in my charitable trust. So I give away my winnings, more than 1.8 million, I'm proud to say, to charity. It's not enough for me to come out here and tell you which stocks I like, because you can't own them if you can't understand them. knowing what you own is a must. It's one of my cardinal rules. Since if you don't have a good grasp of how your holdings make their money, what the companies do of the stocks that you own, you won't have any idea what to do when their stocks turn against you. And believe me, at some point they will turn against you. You can't know when to hold them and know when to fold them, in the immortal words of stock sage Kenny Rogers, unless you know what the heck it is that you're actually holding and what might make you want to fold, in this case, sell the stock, along with what would make you, in the story, if it's intact, buy. Now, the fact is, the profusion of arcane terminology on Wall Street makes it much harder to know what you own. So let's continue our vocabulary lesson with another ultra-important piece of verbiage that's hardly ever explained to you, even though it's used constantly. Risk, reward. The risk-reward analysis pretty much defines the short-term stock picking that all the professionals do. So what does it mean? Let's break it down into two component parts. Assessing risk is all about figuring out the downside, how much you potentially stand to lose in a given stock, how far it can conceivably fall in the near term. Assessing the reward, on the other hand, is all about figuring out how the potential upside looks, how many points of gains the stock could reasonably give you. Too many people, when they analyze the stock, only focus on the potential upside, and that is a grievous error. It's more important for you to understand the risk side of the reward, because the pain from a big loss,
the house of pain,
hurts a whole lot more than the pleasure from an equivalent-sized gain.
House of pleasure.
So how exactly do you figure out the risk and reward? Okay, these are determined by two different cohorts of investors. The reward, the upside, is defined by how much growth-oriented money managers could be willing to pay for a stock. They create the top. The risk, the downside, is created by what value-oriented money managers would be willing to pay on the way down. They create the bottom. To figure out the risk, you need to consider where the value guys will start buying on the way down. To solve for the reward, you have to think about where even the most bullish of growth guys will start selling. When asked, I usually boil the risk reward down to something quick and dirty, like 5 up, 3 down. But how do I get there? How can you know where growth managers will start selling and value guys will start buying? Okay, to do that, you need some insight into how they think. And that requires translating another piece of esoteric Wall Street lingo, growth at a reasonable price. Growth at a reasonable price defines this, and we call it AKA GARP. When we talk about growth at a reasonable price, or GARP, that's not a subjective criteria. It's a method of analyzing stocks first popularized by the estimable money manager Peter Lynch by comparing a stock's growth rate to its price-to-earnings multiple. If you want to figure out the maximum that the growth guys would be willing to pay for a stock, you need to be able to look at the world according to GARP. You want to learn more from Peter Lynch? Go to Amazon and buy One Up on Wall Street and Beat the Street. Those are the two most inspirational books that are the fundament for my own investing philosophy and what I teach here than I've ever read elsewhere. One Up on Wall Street and Beat the Street by Peter Lynch, Amazon. Here we use a quick and dirty rule of thumb that's hardly ever let me down. Although there are some exceptions, a rule that can really help us figure out when a stock is overvalued or undervalued based on what the growth and value money managers would be willing to pay. Okay, let's listen. If a stock has a price-to-earnings multiple that's lower than its growth rate, that's the definition of cheap. Any stock that's selling at a multiple which is twice the size of its growth rate or greater is probably too expensive and should be sold. So if a stock's trading at 20 times earnings and it has a growth rate of 10%, then it probably won't go much higher than that. It's reached the 2 times growth ceiling. Here's another piece of Wall Street gibberish that can help you simplify this process. It's called the PEG, P-E-G ratio. That's the price to earnings to growth rate, or the multiple divided by a stock's long-term growth rate. A PEG of 1 or less is extremely cheap, and 2 or higher is prohibitively expensive. A high-octane, super-fast grower like, say, Google in its heyday from 2004 to 2007 could sell for 30 times earnings and still be inexpensive. Why? Because it had a 30% plus long-term growth rate, giving it a PEG ratio of just 1, right at the cheap end of the spectrum. And the growth kept accelerating, sending the stock to new high after new high. That's how that happened. Where did I come up with these observations? Where are these observations from? The value investors who will be attracted to selling stocks pegs of 1 or less, they create the floor, right? They're looking for a peg of 1 or less. You'll usually be able to find a buyer if a stock's multiple is at or below its growth rate. The growth investors who be buying high multiple stocks hardly ever pay more than twice the growth rate, a peg of 2, which means that almost no way that those stocks can go higher except for the real cult stocks. We know cult stocks can go higher, but you stick with the example of Google back when it still had a mega growth mojo with a 30% long-term growth rate, it would become a sell if it traded up to 60 times earnings, just too darn high, as I've learned over and over and over again since the show began oh so many years ago. Like with any of my methods, or anyone else's for that matter, this one is a rough approximation. It's useful, especially when you're trying to figure out the risk reward, but it's not always right. A lot of times the stock will get cheap based on its earnings estimates simply because those estimates need to be cut, like the banks and brokers right before the financial crisis. Or it will look cheap relative to its growth rate, but that's because the growth is slowing, like Dell during the dot-bomb collapse from 2000 to 2003, as its competitors copied the business model and ate into its earnings power. In these cases, the stock could trade well below the 1 times growth floor. Its peg could just keep sinking and sinking. And the fact that it looks cheap is not a buy signal. On the other hand, the best time to buy cyclical stocks, think the smokestack industrial types, is when the multiples look outrageously expensive because the earnings estimates are way too low and need to be raised to catch up with reality. Oh, one other thing about risk. When you hear the terms risk on and risk off, please ignore them. That was just some sort of gibberish that appeared in like 2010, went away in 2012. Periodically peeks its ugly head, and I just have to bash the darn thing, and that's because it steered regular investors into trading like banshees to buy aggressive stocks or switch to bonds. It is poppycock. I'm glad it got debunked early on before it was practically banished from the discourse as bogus argo circa 2011, 2012. Really hurt people, though, while it was being done. The bottom line, know what you own and know what others will pay for it. That means you need to understand the risk reward, the potential downside, and the potential upside before you purchase anything. By figuring out where the growth investors put in the ceiling and where the value cohort puts in the floor.
Okay, so Kramer just explained risk to reward and growth at a reasonable price. So I'm just following up here to give you a little more information and example of what he represented there. So again, he looks at risk being the downside, and the reward, of course, is the upside. So you want to look at how much risk you're taking and what reward you would get out of it. And to determine the prices where the downside and upside are, he basically identified what would be the value price, or the price at where the value investor would jump onto the stock. And the reward is basically the upside of what the growth investor would purchase it at, or up to what the ratio of the peg ratio the investor would be buying at. So the peg ratio, well, the growth at a reasonable price, he pointed to, it came basically from Peter Lynch. I'm not sure if that's where it came from, but I do remember him using that term and many others using that term 20, 30 years ago. And they had to figure out a way to identify what that growth rate would be and how to evaluate the PE based on that. So in the old days, the PE was basically what was the main determinant of whether a stock was undervalued or overvalued. But when they looked at high growth companies, they find that that doesn't really apply as well. So that's why they adjusted it by actually using something called the PEG ratio. So it's really the PE ratio, PE multiple or ratio, divided by the growth rate. It turns out it fits in fairly nicely for the range we look at. Typical PE is probably in the range of 15. So if you think about a typical company of growing 10% or so, that might put you in the mid-range of PEG of 1.5. And of course, that would be a typical price range. So a value investor would like something less than that. So PE of 10 seems reasonable. So based on a 10% growth rate, that will get you a PEG ratio of 1. Same thing in the reverse, that growth investor willing to pay up for more growth. So a PEG of 2, which represents a PE of, say, 20, made more sense for them. So that's kind of like a rough gauge. It just happened to fall into that range, so that's why PEG of 1 and 2 were kind of identified. In general, individual stocks may have their own different range because of the different growth rate and the field that they're in. So it's a rule of thumb but it's a good way of looking at it to determine your upside and your downside, or your risk to reward. So if we go ahead and follow up as an example, um, we can look at uh, Lockheed Martin. So I'm going to use Lockheed Martin as an example. So the current price as of today, and this is February 28th, so it's at the end of a very tough week for the market. The Lockheed Martin was running at 367 price at the end of the day. And if you look at the earnings per share for 2020, that was 24.26. And we did say it's a rough growth rate about 10%. So if you look at the price to earning of 367 divided by 24.26 divided by the growth rate of 10%, you get a PEG ratio of 1.5. So if you look at the growth investor price at PEG of 2, you basically have an upside target keeping the price open. You have the same earnings per share and growth rate equal to 2. That yields a price of 245 of 485.20. So $485.20 for your growth investor price upper limit. The value investor of using a PEG of 1 gives you a downside target where the price divided by the earnings per share divided by the growth rate of 10% equals 1, yields a price of 242.6 or $242.60. So if you look at the upside is essentially the 485.20 minus 367 current price. You get you a 118. And the downside is the current price minus the downside target of 242 gets you a price target of 124. So you have a risk of possibly losing $124.40 for a possible reward of 118. Or it's about equally up or down. So he would call it one up, one down. So you're in the mid-range. So general suggestion is to look for target where your reward to risk is 2 to 1. So you have a 2/3 chance of success and a 1/3 chance of loss. So if you do this many times, hopefully you'll come out ahead. At essentially up 1, down 1, you're essentially break even. So that's why you want to identify a more interesting stock to buy when it's below the 1.5 and closer to the 1.0 target range. And again, this is rule of thumb. What I suggest you do is you take a look at your stock that you're interested in and look over the last 2-3 years and see where it has been moving around. That will get you a better idea of the up and down of the PEG. Now, in most cases, the growth rate doesn't change very much. And when the growth rate doesn't change very much, you can just look at the range of the PE and how it varies up and down to get you an idea of possible buying and selling targets. So again, instead of going to a PEG, you probably take a closer look at the PE range over time. And of course, earnings are not guaranteed, and earnings are at risk. And because of today's current market and concern with the coronavirus, there is a high probability that the earning target will be missed for this next year, possibly next quarter or two. We'll have to wait and see. But because of this risk, there's expectation that the price is overvalued now because the earnings should be dropped even further. But since this is an exogenous event that is temporary, I would expect Lockheed Martin being not significantly being affected in the long-term growth, since their business is mostly defense related. So this is an opportunity possibly to be picking up Lockheed Martin. So let me go to the website and review the earning targets and such again. So again, for this stock, Lockheed Martin, Charles Schwab, again, provide you an estimate of a couple of years. And again, you get 2 years, you get essentially the next year or this current year of 24-26, plus a future year of 26-55. And you can basically, like I said, get about a 10% growth rate based on that. And in my case, like I said, I use E-Trade. So E-Trade basically provides research similar to all of them. You have your earnings, your fundamentals, which is basically the income statement information. But you can see here, you get a 5-year projection, or 5-year shown here with a 4-year projection with 2020 and 2021, which has the same value of 2426 and 2655. But you also get the 2022 projection of 2886 and a 2023 of 2743. So what they're probably identifying is there's not a current visibility of a 4 years out of additional income as yet. With the defense industry, they have general long-term contract, so they can make a little projection a little further out than most. So in this case, it says basically they are flattening out. So if you want to, you can use an earning somewhere in the middle between here for the entire range. But at this point, I would just say keep an eye on the future as the year go by. But within a year, you can see price can vary significantly. So in 2019, for instance, price was here around 275 up to roughly 440, 30, or $40. So that is a significant range. And if you look at the PEG range here, you can see at 270 for a 2020 target price, that would essentially be a 20, basically 270 divided by 24 will get you a ratio of about 1.1. So at that point, it would have told you that was fairly undervalued. And in fact, it got a low of 250 and actually 240. So possibly based on a 2020 price target, it would have been a PEG ratio of 1. So at this point, you probably could have picked it up and be in good shape. But as I said, it went up to essentially 440. So essentially, it's now up at the high end almost for the target of 480. So again, it's pretty close, and all of this done within a year. If you go back to prior year, you can take a look at the 2018 price against the 2019 earnings and get an idea of what the PE variation is here. Or as I said, look at the PE. So here's another thing that I enjoy about E-Trade. You do also get the PE trend. So if you look at the PE trend, unfortunately this is the trailing 12 months. So this is Lockheed Martin PE TTM. So it's a trailing 12 months. So it basically shows you how the price of earning varies on a daily basis. And what you see here in the jump, and the PE is basically the first column of numbers here. It took a jump here, which kind of says the earning was probably a little less because it was adding in this quarter's earning and dropping off the last quarter earnings to get the trailing 12 months. So as a result of that, it must have been a decrease from the prior 12 months earnings that is dropping. So it looks like it's a significant PE jump. And again, the next quarter, again, the numbers drop back down, which probably says the trailing 12 months earning was less than the current quarter earning that was just reported. And again, you see it drop again. So you hope this drops continuously. So as you can see here, it has been dropping continuously, but the PE was quite high. It was at a 50 here. It went to a 40 and close to a 30, and back down to almost 20 when it reported here. When it was running historically before this, it looks like around 22 or so. Now if I go ahead and stretch out the time frames to 4 years, you can see it was sitting closer to 20 and it started to climb up gradually. So at this point, a 20% PE versus a growth rate of 20% made it fairly reasonably valued. So if you had bought in on it at that time, you would have essentially achieved this gain. But then you would have looked at here and tried to guess whether it would be able to maintain that. It looks like it got into a reevaluation at this point, and now the new peg ratio seems to be along here, which was closer to 16, 17 or so. And recently it got back up to PE of roughly 20. And at this point, of course, it's taking a big dip right now where I said it's a PE of roughly 15 right now. So whether it's reached a point where it's considered reasonable for buying is questionable, but it could be. In fact, it might be a good time to nibble on it since it looks like it may still go downward, but I don't know if you're going to get down to the PE much below this area because this is a PE already about 20 and 18, 16 seems to be the low. So I think you're at the lower end of it. Will it be back up here in the low 20s? At least here, I think you're currently running at a reasonable price range of PE of 15. So you have potentially a earnings increase of to 2. And another way of looking at the stock, I also look at the analyst trend on revenue upgrade as well as earnings upgrades and downgrades. So here you can see you have Q1 of 20 trend, and this is Q1, so we'll just look at that by itself. And you can see there was upgrade here, a slight downgrade, a few upgrades here, and then of course Q3 there was a projection of some downgrades for their future earnings for this quarter. And if you look at the Q2, you get similar numbers up here and down here. Q3, similar things. So in this earning time frame, when they reported, they probably indicated some issues or some contract improvements, but also in this time frame there might have been some issues that was brought to bear, and as a result future earnings were dropped. And again, if you look at Q4, you see the same thing. Some upgrades here and then some downgrades here. So you might want to review the Q3 earning report and see exactly what happened and what the projection was. Okay, so this gets you an idea of how to value the stock and to take a look at the range, and you can investigate yourself, but I would investigate whatever stock you're looking at and use these values to determine the PEG range or the PE range. Okay, hopefully this will end part 2. And the only thing I want to remark is that earning, again, is an estimate, and they tend to move up and down with what the company says in their earnings reporting, and they are only an estimate, and generally they are behind the curve. So if there is upgrade, downgrades, those are what I track to determine whether the trend is in the right direction. What I usually like to do is see a bunch of downgrades over the past and then upgrades in the most recent terms to basically say the company has turned around and the analysts are behind the curve of what the actual company is doing. But as more analysts start to upgrade, the more likely you're in a good company that's having some positive trends. Okay, thank you.